Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
On the 1st of August, the Reserve Bank of India's MPC will meet to discuss if the policy rate, the repo rate, needs to be hiked. The MPC hiked rates last time around, and since then, an aggressive minimum support price program for crops has been announced. Corn inflation has jumped, food inflation has dramatically slowed, and externally, the yuan is threatening to weaken. In this backdrop, the CNBC TV18 Citizens Monetary Policy Committee meets to discuss what the official MPC ought to do on the 1st of August. The Citizens MPC is today attended by all its members. Samiran Chakrabarti of Citibank, Sajid Chenoy of JP Morgan, Soumya Kanti Ghosh of State Bank of India, Sonal Verma of Nomura, and Chairman Pranab Sen. Good morning to all of you, ladies and gentlemen. Well, Sonal, actually, I should begin with you as the lady. The most important event that has occurred between June and the August 1st policy is the minimum support price announcement. How worried would you be about the MSP, and do you think that's going to dominate the MPC's thinking?
The MSP announcement that the government has, now that's clearly known. The main question is whether MSPs actually become effective. And while there are, three procurement options that are being contemplated to make MSPs effective across all crops, the challenge, I think, for FY19 is basically implementing this across all states, across all crops, because there's a lot of infrastructure backing that is required. So I think the overall impact of MSP on inflation without an effective procurement across all crops is closer to 20 to 30 basis points. Of course, if procurement happens and they make it effective across all crops, then the impact in our view could be 70 to 90 basis points. But we don't think that will show up in FY19. So I think the bigger driver as far as the decision is concerned is not so much the MSP, but really the core inflation and the build-up in core momentum that we have seen, which is clearly quite significant.
Yes, that will have to be passed. I agree with you, Sonal. So let me toss that to the chairman. Chairman, sir, a substantial food disinflation, on top of it the MSP, and crude that doesn't look as frightening as it did 2 months ago. How will should the MPC, this MPC, parse the inflation number and the trajectory?
Well, I think Sonal put it fairly clearly. If you recall, the last MPC meeting was dominated by MSP and oil prices. I think now we have a certain amount of certainty in both. So there's nothing left to speculate about, except the extent to which the MSP is going to be effective. The real question that's going to face the MPC is core. And the reason why core is going up, nobody knows. Soumya has this very nice paper where he actually discusses the components for the acceleration in the core. But it only provides a pointer rather than an explanation. And until we really have an explanation as to what's going on, because if you really look at Soumya's paper, he says it's essentially been driven by services, which really leads to a very substantial question, which is that this whole business of linking inflation with the output gap doesn't seem to be working terribly well out there, unless you're defining services in a particular manner. So I think the MPC has a real challenge in front of it, which is number one, diagnosis of why core inflation is going up, and to date I really haven't seen anything worthwhile on the subject. And second is, what do you do about it? Now, the point is that since the core is going up, and given the mandate of the MPC, I have a feeling that there's only one way that they're going to jump.
Okay, core prices. All right. Actually, since, Sajid is waiting to speak about core, but, Dr. Sen has referred to your paper, Soumya. So tell us where you stand on the core inflation argument before I get to Sajid. Do you think it is worrying enough? I mean, 6.3 was the last number, the June number.
No, I would be dishonest if I say it is not worrying enough. Yes, it's worrying enough. It is running at more than 6%. The last was 6.3%. But if we actually dissect the core inflation and the number from when it started to go upwards from July 2017 till June 2018, I think the worst is behind us. Okay. And if you look into the core inflation weighted contribution to the overall headline inflation, you will find that housing and the transportation segment has contributed to around 60% of the increase in the core inflation. Yes, there is increase in health education, the basis percentage point increase. Education is there, but the increase in health and education combines around 18 to 19 basis points. So there is an element of service component in it, but I think a large part of it is also driven by the health component, by the transportation component, which is the oil part, and the housing component. And my sense is that the housing component contribution, which is around 37 to 38 basis points, which is now very close to the 40 basis point, which was estimated by the MPC and the other market estimates, is very close to that. It has peaked out. And also, if you look into the momentum of the core inflation, it is now slowing down on a seasonally adjusted basis, and also on a month-on-month basis. If you just look into the data, it has slowed down, and our estimates suggest that possibly towards the end of March 2018, because now you have a very favorable base effect. If you look into the base effect, pure base effect, I think the numbers is going to hit below 5% by March 2018. So the point is that we need to now look into wait and watch the data, because now the MSP factor will come into play. And let me mention a small point over here. After the MSP prices, we looked into this market prices and the MSP. The market prices are still significantly lower than MSP, but for 4 crops, for example, bajra, maize, groundnut and sesame, there is a 15 to 20% increase in the market prices, which contributes to around 7 to 8 basis points of the headline CPI number. So my sense is that 2 months of wait, you will get a clear idea, because there is an possibility of an increase in the market prices, even though they are significantly depressed as of now. And after 2 months, once you get a clear picture, then more of core inflation will be better, because now oil prices now also stabilizing. So stripping out the oil, you can then have a fair idea of the core movement.
Okay, so Soumya quite solidly making the argument that you ought not to be terribly worried. Well, Sonal is worried about food inflation, MSP inflation, Dr. Sen about core inflation. How would you round this up, Sajid? You agree that this base effect will take care of core inflation, or you worry about
I worry very much
momentum
about core inflation. First, let's just agree on how we define it. And Soumya is right. We should take out petrol and diesel, take out housing, and get to what I call core inflation. Just look at the momentum of that over the last 8 months. Core inflation has averaged almost 0.5% on average over the last 8 months. What is the new information we have since the last policy review? May core inflation got revised, the momentum from 0.5 to 0.6. June momentum on the back of that elevated number was 0.4. Right? Okay. That's still very elevated. So we're sitting in June looking at core inflation, core, adjusted for these components, running at 5.6%. This is not 1 or 2 months, this is now happening for 8 months. So something clearly is going on where inflation has become much more generalized. Why is it happening? In my view, 2-3 things. Number one, if you look at rural wages in the last 3-4 months, carefully adjusted, the month-on-month momentum has gone up. We know the government would like to reflate the rural economy. Number two, output gaps have closed. Growth has been quite strong. Number three, we're seeing the lagged effects of some pickup in oil prices, which may have stabilized. Number four, the rupee. We found in previous empirical work there is a reasonable pass-through from the rupee to core inflation. So I think there are enough worrying factors to suggest the momentum may not stop just as yet. I'll just make 2 final points. What is new compared to the last review? Number one, that core inflation remains elevated. Number two, that the MSP risk has been realized. Number three, that we could have more emerging market currency weakness for 2 reasons. One is the dollar is strengthening because the global economy has become much more desynchronized. US growth in the second quarter is 4.4%. Europe is slowed. And the CNY is depreciating. So we could see more rupee weakness going forward, which is what India cannot afford to avoid given the real appreciation. That will need to be countered through. My last point is, let the framework be the same. 1 year ahead, where is inflation? The RBI said 1Q19 will be 5% at the last review or thereabouts.
Yes.
Now with the MSP risk being realized, that 1Q19 will be above 5%, which in my view will be enough for them to worry.
Okay, well, I cannot give you the luxury of talking about core inflation again, Samiran, because we have to cover other areas. Now, would you worry about the fisc? Even if the MSP didn't hurt the core inflation, would fisc be a worry? GST rates have been cut. Already inflows are not as good.
Well, clearly, fisc has been a worry for the central bank for some time now. In our view, for the full year, it's a bit early, premature to talk about fiscal slippage. But if you look at the state finances report from RBI, it clearly articulates that the slippage on the state finances side has been quite systematic over the last few years. So much so that the farm loan waivers are almost becoming equal to the whole NREGA payments for the full year. And then that's something which would be adding on to demand pressure. So from a overall demand side perspective, the fisc is a worry. But in August, right in the beginning of the fiscal year, it's probably a bit too much for the MPC to take a call on how much slippage would be there and to what extent that will get transmitted into an inflation impulse.
Okay, so yeah, clearly, the quality of the fisc could deteriorate, but the amount of borrowing may not change. The borrowing is a worry because they're going to borrow more in the second half. But we have lots more to discuss. We haven't looked at the growth trajectory and whether the best is behind us and what will the MPC ponder in terms of growth impulses, as well a little more color on the external sector. All those questions to our MPC members. After a very quick break, we are back. Welcome back. We are in the midst of the deliberations of the CNBC TV18 Citizens Monetary Policy Committee. Our committee has expressed their concern over core inflation, though of course there are members like Soumya who believe that core inflation, because of the base effect, will not be a worry going forward. But what we have to also worry about is growth. Well, Dr. Sen, what would you say? Is the best of growth behind us, as some people have argued, and therefore too much of aggregate demand need not be expected going forward?
That's difficult to say. I think that, there are two contradictory forces in operation. The first, of course, is that I think the banking sector is starting to come out of the funk it has been in a while. So that's a plus. The minus is that trade wars now look very much more likely. Okay. Which means that the external effect is going to be far weaker than one had hoped. So it's a little difficult to say, but I would actually moderate my growth expectations at this moment.
Okay, so that won't be a very hawkish factor. Would you agree, Samiran? Would you say that growth will not be as much of a hawkish factor as it was?
I mean, if you look at last half of FY18 and early part of FY19, we are coming off a low base of demonetization and GST-related disruptions. In fact, the July-September quarter, in some sense, will probably be the first clean quarter without these base effects. And we need to see how the growth numbers hold up for this quarter. Our sense is that the 7.7 that we have seen is probably close to the peak for FY19. So from here on, we would see some moderation in growth numbers. I'm not for a second suggesting that it's still not a substantially robust growth. It's still a substantially robust growth, particularly in the context of what Dr. Sen mentioned about the global dynamics. Yeah. Even if we get somewhere between 7 to 7.5, in my view, that's a very good number to have. But sequentially, it will appear to be somewhat of a slowing down.
Okay. But you think it will be a hawkish factor, I mean, aggregate demand?
I mean, the MPC always worries about it, but incrementally between June and August, I don't think we have heard enough information on growth which would change the stance on growth materially between June and August.
Unless, of course, they worry too much about trade wars. But Soumya, if you can put the external piece in context, we have had trade wars mentioned, we have had crude mentioned, but how should the MPC parse all the pieces?
See, I believe that the external sector is actually a matter of concern, because if you look into the US-China trade wars, and as Sajid was saying, yes, US is possibly going to hit a growth rate of 4%. The ECB could actually end tightening towards the end of this year, but you have to also juxtapose the factor that the wages are actually being significantly depressed in US and across the world for the last couple of years for various reasons. But there also in Japan, if you look at the experience of Japan, the inflation target could actually be lowered by 1 percentage point in 2019 than what it was earlier projected. And also in China, the interesting development is in China in the last 1 month, the won has depreciated by close to 4.5% against the US dollar. And there are reports in the market that the Chinese central bank may possibly want the yuan to gradually depreciate, because there has been talks of currency manipulation and others, so they want the currency to depreciate. But the flip side of it is that if that happens, that will drag the entire region's export growth rate downwards. And in that case, the central banks like Indonesia, which were actually hiking the rates, could not possibly do that till 2019, till the trade wars are resolved. So I think that's a serious issue which we need to look into. For us, the domestic factors, if you look into the credit growth rate, has picked up in some of the sectors like commercial vehicles. The replacement demand is strong. Tires also is one of the segments. Cement is one of the segments. But I think a broad-based recovery is still far away. And if I juxtapose the external sector factors into account, I think that the US possibly is also veering towards a less of aggressive rate hikes in 2019, even though a September rate hike could be a possibility. So taking all these factors on the table, my sense is that exports are unlikely to push up growth to domestic growth to a significant extent, and domestic demand as of now doesn't look entirely promising.
Okay, so the external sector need not necessarily make for a hawkish MPC. Well, what about liquidity, Sajid? Would you worry that, anyway borrowing is going to be higher in the second quarter? So that perhaps is going to take care of yields, push up yields, or at least not allow yields to fall. Therefore, need the MPC hike at all? Because the market is going to take care of that.
Well, I'm not sure. I don't think the MPC should keep changing the goalpost that, because yields have moved up or down, we should not stick to our mandate. Because I think by that logic, they should not have cut rates last June or hiked earlier this year. I think on the liquidity front, the policy is quite clear that durable outflows in liquidity will be met by durable injections. What's notable is between January and June, currency in circulation has been surging, growing at 40% over last year for a variety of different reasons. If that pace continues, and given the pace of BOP intervention we've seen, you may require anywhere from, 2 trillion of base money to be injected in this fiscal year. Now, if the RBI is selling dollars to prevent more depreciation, the only way to inject that is through open market operations. And I think that's why you've begun to see this systematic plan where every month there's one OMO being done. I think if currency in circulation continues at this pace, the pace of OMOs in the second half of the year may have to increase to meet those liquidity requirements, which from the bond market's perspective provides some relief. So the tug of war will be, on the one hand, borrowing in the second half is higher. You could have some fiscal slippage from the state perspective, but offset a little bit by the OMOs the RBI will need to do to stick to its liquidity policy of keeping liquidity close to neutral.
So it will keep liquidity neutral?
Close to neutral.
Okay, MPC will not want to change that. Any change, they would keep liquidity neutral?
I mean, while we are saying that second half central government borrowing will be higher, we have to keep in mind that the state government borrowing in the first half is higher year over year by 25%. So to that extent, if the states don't slip much on the fiscal, the second half borrowing requirement for states could be a tad lower, balancing out the central government's higher borrowing. So I think it's a little bit planned here that to push more state borrowing in the first half and have lesser state borrowing in the second half.
Fair enough. A stance, we didn't discuss that. Sonal, do you expect a change in the stance of the MPC, and how important will that be from a market point of view?
I think, markets were more contemplating a change in stance potentially at the June policy meeting. There is no expectation, I would say, for a change in stance in August. So if it happens, that'll be a big negative surprise. If the MPC does deliver another hike in August, then it would have been a 50 basis point cumulative hike. I think at the margin, there has been a tightening of financial conditions in the last 9 months, and the global growth outlook is also turning more negative at the margin. So, I think the current growth numbers may not sustain over the next 12 months, and that itself might mean some moderation in core inflation. So I think with the hikes that we think, will get delivered, that should be sufficient for the MPC to wait and watch to see how things pan out. So really there is no need for a change in stance at this stage now. Okay, so the much feared Viral Acharya phrase, withdrawal of accommodation, will not make its presence in the current policy stance. Dr. Sen, can you put all these pieces together before we start our vote? What would your last comment be as the MPC chairman?
Well, I think as far as the MPC is concerned, I believe a lot of what we have discussed already got factored in the last policy. The question now is that do they need to do anything further? And if so, why? So far, I don't think there is really any compelling reason why anything has to be done further at this stage. There are too many imponderables, particularly on the global front. I think Sajid is right. The only thing that I think is fairly clear is that the dollar will strengthen. All currencies are going to be weaker relative to the dollar. But the real question is what is going to be the relative price of currencies other than the dollar. And that really is going to be the big question. Because with the kind of trade war that's looming ahead of us, the competition for alternate markets is going to become much, much more aggressive. And that's going to be something that certain countries, China almost certainly, are going to be doing aggressively and deliberately. Our stance has always been that we do not tinker with the exchange rates, but in which case you have to figure out what you do in terms of your other macro policies, because that is going to be the big challenge ahead of them.
Okay. Well, I am tempted to continue with this conversation to check whether India should be hiking and appreciating its currency at a time when competitive currencies are going to devalue. But I'm afraid we are run out of time. Gentlemen, you have to pick up your boards and vote. The first question to you is, will there be a hike on August 1st? Will you want a hike on August 1st? Let me start with the lady. How would you vote, Sonal? Yes.
Hike by 25 basis points.
MPC hikes by 25 basis points. Soumya?
There should be a pause.
Okay, there should be a pause. Shamiran, pause. So 2:1 in favor of a pause. Sajid? Sajid, hike by 25 basis points. Chairman, your casting vote becomes important. 2 members want a hike, 2 members want a pause. Which way would you tilt, sir? Pause. All right. So by a smidge, by just 1 vote, by the casting vote, the pause win it. Okay, so no back-to-back 2 rates. But how many hikes do you expect counting the August hike? Sonal, that's the second question. How would you vote, Sonal?
We're expecting a hike in August and then a pause from the MPC.
One and done. That's Sonal's vote. Samiran, how would you vote? Okay, so you expect 1 hike, not in August. Fine.
Yeah, it's maybe one.
Maybe 1.
Yes.
I will take it as 1 more hike.
Yes.
So 3 of you are saying there's only going to be 1 hike in 2018, and of course for Sonal that hike is coming in August itself. Your vote,
so for the fiscal year, 2 hikes.
Oh, for the fiscal year, 2 hikes. So up
August.
until March, you're expecting 2 hikes. Dr. Sen, how many hikes do you think from now, as we speak, July to March. Okay, only one more hike. Fine. So Sajid clearly is more hawkish than the rest. Probably 2 hikes is what Sajid is expecting. But for August 1st itself, this Citizens Monetary Policy Committee of CNBC TV18 expects that there will be no rate action and actually not even perhaps a change in stance. Thank you very much, Chairman Sen and members of the Monetary Policy Committee, for your deliberations.